Welcome to the debate. Our focus today is on, well, one of the most pressing issues in the resource sector, the employment outlook for mining professionals as we head into 2026. This is all anchored in some recent expert analyses that detail a huge structural transformation that's sweeping the industry.
And that structural shift really is the defining feature here. I mean, the consensus is pretty clear. The industry is moving, and I think irrevocably, away from that old drill and haul model towards something more like digital and sustain.
Absolutely. And what that means for people's careers is just vast. So, the central question we really have to grapple with today is this. Does this profound transformation represent, a net positive growth opportunity for professionals? Or does it introduce these significant pitfalls and talent mismatches that actually impede career stability for the majority?
I'm going to be arguing that, while yes, these highly specialized opportunities do exist, the hyper-specialization required, the persistence of commodity volatility, and just the stagnation in traditional roles, well, they create profound career friction and major risks for a huge chunk of the workforce.
And I'll be maintaining that this transformation is fundamentally unlocking robust, high paying opportunities. And these are fueled by strong, long term demand in critical minerals and, just as importantly, the massive, unavoidable demographic need for workforce replacement. I see the 2026 job market as not just changing, but fundamentally expanding. It's offering a substantial path forward for any professional who's willing to integrate technology into what they do. My position really rests on three undeniable drivers here. First, the critical minerals boom. This is providing unparalleled long-term project investment. We're seeing sustained hiring in exploration, advanced processing, specifically hydrometallurgy, and, essential supply chain logistics. This isn't a short-term thing.
You're focusing on those high-value new areas.
They are the future, and they need people right now. Secondly, we have to talk about the sheer volume of workforce replacement that's required. The reports confirm that the U.S. alone generates 11 to 13,000 new job openings per year. Almost all of that is driven by retirements and churn, so that guarantees steady openings even if core expansion is modest. And finally, these new digital fields, they command premium wages. Roles like automation engineer or a remote operations controller can earn between $110,000 and $180,000. And jobs in green transition roles in mining, they're projected to grow by 18%. The message is pretty clear. Embrace transformation. That's the path.
I see why you think that. I mean, you're emphasizing the compensation, the energy transition. But I think focusing on those high-end salary numbers really masks a severe structural problem. The data suggests that while, yes, high-end opportunity exists, it's so highly concentrated in these specialist niches that it's largely inaccessible to the core of existing professionals. That's where the pitfalls are. The headline growth story is frankly misleading.
How so?
Well, look at the core engineering data. The Bureau of Labor Statistics projects only about 1% employment growth for mining and geological engineers between 2024 and 2034 in the US. I mean, for all intents and purposes, that's a stagnant or even a contracting job market for the very people who traditionally run the technical side of the mine. The growth you're citing, that 18% in green jobs, it's a fraction of the market. The real surge is in hyper-specialization. We're talking about fluency in Python, designing digital twins, mastering specific ESG compliance frameworks. You're asking a mining engineer to become a data scientist and an environmental lawyer all at once.
And that's a good thing.
But it creates a catastrophic talent mismatch. Traditional operating jobs are being consolidated or just augmented away, leaving experienced workers behind. And look, the industry has not escaped its reliance on commodity prices. It's still highly cyclical, it's still geographically volatile. Hiring still tracks those price swings, and the strongest hiring is overwhelmingly in remote or hard-to-staff locations. That requires intense personal flexibility, fly-in, fly-out rosters, which introduces huge lifestyle constraints and retention risks. The net benefit to the average professional is just so much lower than the headlines suggest.
Okay, let's focus on that core point then. this idea of job growth versus stagnation. You're relying pretty heavily on that 1% BLS figure for engineers to suggest stagnation. And yeah, 1% over a decade. When you look at it in isolation, it looks concerning. But how can you say the market is broadly stagnant when we know demand is shifting away from traditional extraction and toward complex processing and digital optimization?
Because that 1% figure applies specifically to the degreed technical engineers. It signals that companies need fewer conventional engineers to manage operations, thanks to the very digital systems you're championing. So, while the industry needs more programmers, it signals a consolidation of the core engineering workforce. The question isn't whether new jobs exist, it's whether the current workforce can actually transition. And that stagnant growth rate is the red flag that's signaling displacement.
That's an interesting point, though I would frame it differently. That 1% figure completely ignores the sheer volume of replacement hiring, those 11 to 13,000 annual openings that ensure steady churn and opportunity. And I also just fundamentally disagree that these specialized hybrid roles are niche. They are foundational requirements for modern mining. I mean, you look at a place like Australia, roles like project development manager, advanced process metallurgists. These people are commanding salaries between 160 and 230,000 Australian dollars. This shows that value hasn't contracted, it has just shifted. The engineer of 2026 absolutely demands these hybrid skills.
I'm sorry, but I just don't buy that line of reasoning when we think about the individual situation. The roles you're citing require completely new, high-level skill sets, fluency in digital twins, Python, ESG compliance. You're asking technical mining experts to basically become half IT professional, half mining expert. The pitfall here is the risk of that transition.
Risk exists in any evolving industry.
But this risk falls squarely on the professional. If a company can't recruit or, more importantly, train this new talent pool efficiently, and that is a clear risk noted in the source material, then that growth you're talking about just stalls. And if a current, experienced mine planner invests thousands in self-funded retraining to become a digital mine supervisor and fails, they're left with obsolete skills. That opportunity cost is massive, and you're just calling it a challenge.
I concede that expensive, self-funded training carries a high opportunity cost. That's undeniable. But the industry demand justifies the risk. The fact is, the market is willing to pay those premium wages precisely because that hybrid talent is so scarce. So if we accept that digital transformation is mandatory, then that investment, however costly, is the prerequisite for accessing the high-value segment of the market, which is clearly growing.
Okay, let's shift then to the volatility of that market. You argue that the demand side is more stable now because of the energy transition. You see demand for critical minerals, lithium, copper, fueling genuinely long-term project investment, which you say should insulate jobs.
Exactly. This is driven by massive macroeconomic and geopolitical forces. EVs, grid modernization, defense supply chains. This strategic importance means job security in these sectors is inherently less exposed to the short-term price fluctuations that have always plagued base metals or thermal coal. You have government backing now that makes these projects fundamentally more robust.
That's a compelling argument, positioning them as insulated. But have you considered that even this demand is cyclical? The source material warns explicitly that job availability will still mirror commodity price swings. If lithium prices correct sharply, or if copper demand dips because of a global manufacturing slowdown, which is entirely plausible, capital dries up instantly, even for the strategic projects.
But those dips are temporary. The long-term trajectory is stable.
The trajectory might be stable, but the hiring isn't. And what about permitting bottlenecks? In North America, across the lithium triangle, they delay projects for years, so hiring gets deferred regardless of the long-term demand. The reality for professionals is that project expansion roles, the very high-demand jobs you mentioned, are the first to be frozen or cut when capital markets get cold. The boom and bust cycle persists.
While project downturns will still bite, we can't deny that, the key change is the strategic backing. When governments in the US and Canada prioritize domestic projects for national security, they're providing a layer of security that didn't exist for, say, iron ore. But beyond the commodities, look at the sustained side of it. Roles tied to sustainability and community relations offer incredible stability because they're required by social license and by regulation, completely irrespective of commodity prices.
I'll concede that ESG roles offer stability, but their volume is still smaller than the operational jobs. Which brings us to the massive constraint impacting most of the workforce: geography. Most new, high-demand operational jobs are concentrated in these hard-to-staff regions. We're talking deep underground sites in Nevada or Canada's Arctic North. This demands huge flexibility on location and intense roster models.
And that is simply the reality of where resources are located.
Exactly. And it's a severe constraint. It's a major pitfall for professionals who want a standard, community-integrated career. The industry is essentially creating a barrier to entry for anyone unwilling or unable to subject themselves to a 14-day on, 7-day off FIFO roster. That puts immense strain on family life. It's an opportunity that comes with an intense personal cost.
I come at it from a different way. The necessity of working in remote locations isn't punitive. It's the fundamental economic driver that fuels the premium wages. For those willing and able to be flexible, this is a massive opportunity. FIFO contracts for specialized roles can reach up to $220,000 globally. For electricians or technicians, you're looking at $110,000 to $180,000 Australian dollars in FIFO camps. It's exceptionally compelling.
The reward is necessary to compensate for the isolation and the intensity.
It's a market mechanism. Flexibility opens up significantly more opportunity, especially when you're staffing new critical mineral sites where local talent just doesn't exist yet.
Arguing that remoteness is a pitfall ignores that this geography is precisely what creates the economic condition for that high salary that many professionals are actively seeking. But regardless of the incentives, the net effect is a split. A small, highly paid, digitally skilled, and geographically flexible elite, and then a larger group of traditional professionals who are facing stagnation, displacement, and the immense pressure of bridging that huge, expensive skills gap. The benefits are not being democratically distributed.
The job market for mining professionals in 2026 is, at the end of the day, undeniably vibrant, provided the individual adopts. The structural change is positive because it replaces high-risk roles with careers centered on digital operations, ESG compliance, and the strategic critical minerals value chain. It's fundamentally changing the character of a mining career for the better.
The market is transforming, yes, but for many, this transformation is challenging and risky. We have to recognize the severe talent mismatch, the stagnation in core engineering roles, and the pervasive risks from commodity cycles and remote work demands. The path to success in 2026 requires extreme specialization, and for those unable or unwilling to upskill that rapidly or relocate, the pitfalls of displacement and volatility remain acute.
Ultimately, I think the analysis clarifies that the entire ecosystem, professionals, companies, recruiters, needs to fundamentally rethink skills, location, and compensation.
Right. Understanding precisely where the market is contracting and where it's demanding these sophisticated hybrid skills is absolutely essential for anyone trying to navigate this complex, high-stakes environment.